Hey everybody, let me know if you can see me. I don't see chat, Nina. Pull it up over here. Can you see me? Hey everybody, we're going to get started in just 1 minute. All right, let me know while we're waiting until the hour who's on and where you're checking in from. Let me know in the chat. Hi, Michelle. Amsterdam. Oh my gosh, I love it. All right, very cool. Hello, hello, hello. So it's 3 o'clock. We're going to get started. Apologies about last week. I was traveling and I tried to log on and I had no internet. So thanks for your patience and sticking with me. I am ready for a rock star session. I know Christmas is just a handful of days away. So I want to say happy holidays to everybody. It's pretty sunny behind me, so hopefully that sun is not like annoying. I'll try to like stand in the middle. Yeah, so let me know some questions before we get started. Let's see, North Carolina, Cleveland, Houston, all over the place. I love it. I am back in New York. I drove here 5 days with my daughter and my dog, actually, in a super small car. And here we are, so it's pretty cool. So let's get started. I don't want to waste any of you guys' time. I want to have a rockstar session. I want to have a lot of like really interactive Q&A. I get a lot of questions in my YouTube via comments, but the live sessions are really meant to give you guys an opportunity to get more, I don't want to say one-on-one, but like one on more intimate setting and have your questions answered on the fly. My intention here is always that you guys learn exactly what I'm doing and what I've been doing for a super, super long time in order to create yourself income on a regular basis. So what I'm going to do first, and I'm going to look through the chat as we go to answer questions as we're going, but I'm also going to pull up my account. So here's this $5,000 account, and let me pull up my also the broker-dealer platform. So you can see it's just in cash right now. So a couple of things that we look at. Now, different platforms are going to have different formatting, but it's all going to be kind of similar information. You're going to have a place where you see your positions, right? So like what stocks do you have? What are the options contracts that you have? And then you're going to have also a place where you see your realized gain. So realized gains are most important because this shows you how much money you've made so far. Now, last week or the week before, you guys might remember, I sold the Riot. I think that was Riot, the Riot put, and that expired worthless. So I sold that for 11 bucks, less a commission. You always pay a commission when you trade any contract. So I think my commission is like 51 cents or 61 cents or something like that. So I netted $10. And then that expired worthless. I also had this Applied Digital. That was an accident. I meant to trade that in a different account, but it went into this account. So you'll see right here, this is what I want you to focus on. What's your net gain? And what's your gain-loss ratio? So your gain-loss ratio is always going to be like 100%, maybe the high 90s, depending on if you're adjusting any positions. We're going to talk more about that as we sort of walk through live trades. But really, I want you to focus on your realized gain over your unrealized gain or your paper gain, right? So remember, guys, when you trade stock, if you just buy stock and the price goes up, you can't spend that. It's only a paper gain. So really, you want to create realized gains via options. So right now, I just have this 5,000 bucks, $5,029 to be precise in this account. And it's not a big account. And it's interesting because before this session, I was trying to think, what should I trade today? I don't know. I traded Riot because it's not that big, and I don't want to use margin. So margin we haven't really talked a lot about margin. I've talked about it here and there, but margin can be very dangerous in the sense that what it does is it lets you trade more things or perhaps trade more expensive tickers than what your account size allows, I guess you might say. So you're not putting up all the cash, but you're using some money from the broker dealer. And what happens is if the stock goes down, you can be in a lot of trouble if you don't have enough money in your account. So I'm not using margin because it's much, much safer to not use margin. And the only time you lose money, and this is important for you guys to hear, the only time that you lose money is if you sell something for less than what you paid. If you liquidate a position for less than what you originally paid for it or what you originally received in income, depending on what type of position it is. So the only thing that creates a requirement to liquidate something early and take a loss, a real loss, is if you're using margin. So I'm not going to use margin, and I'm going to show you how easy it is to make money every single week. Now this works for whether your account is big or small. And the reason why I'm using this small account is to show you that you don't need a lot of money to make income for yourself on a regular basis. So I just kind of started taking a look at a few things. Personally, I like the crypto stocks. I'm going to be honest with you. I think crypto, let me see where Bitcoin is right now. I think crypto has been down. Here's how I do it. I just look at BTC price. Right now it's down a lot. And I feel confident that over time it will go up. And if it goes down more, it gives me an opportunity to sell another put, buy more shares as the price comes down. And I can also, so it's for all these different reasons, I can also invest with not a lot of money, right? So last week or 2 weeks ago, I did Riot, which is a Bitcoin stock. Now I'm going to do Mara. Mara, I haven't traded that in a while. It's another Bitcoin mining type stock. And always what I first do is I always look at the chart. Where has the stock been going kind of all year, right? So this is the past 52 weeks, and we'll see that it's pretty low. Now, what I look at visually, I don't spend a lot of time on my videos talking about, technical analysis or looking at chart patterns or indicators, but there are a couple of things that I do look at. And when I come across that, I want to make you aware of it. And because what I want to do is I want to share just all the knowledge and all the tools that I use to make my decisions so you can learn to understand that and use that in making your own decisions. So this is one thing that I see looking at this chart. So I just kind of look and see where the low has been. So right here back in April, it looks like if you look at the black bar above me, it shows the low of 981 on this particular day, on April 4th, right? You can see my crosshairs kind of marking that particular day. So 981. And then over here, back on 11/21, it was 971. And over here, it was 961. So you'll see kind of like, we call this like testing that support level. So what happens is the pricing comes down and tests it, and then it pops back up. That's what happened before. So that's what happened here where it came down, it kind of went up, and then it came down all the way down, right? So this is a really steep decline, very significant in a short period of time. And then it kind of popped up, and now it's testing this bottom again. We call that kind of like a double bottom, right? So I think this is a good time to sell a put. So like when stuff is low, we can get paid more money. So let me take a look and see what the contracts are going for. So I'm going to click the trade tab. And let's see. I'm just looking at the questions as we go. Somebody asked, Patrick asked, why does the screen image not go full screen size? I'm not sure. I think that must be your setting. So there should be a way that you can enlarge that. Also, if you can't or if you want to reference this again, all of these recordings, just so you know, and it's also important to note in case you miss some time, because we know things, you're not just sitting there waiting for Michelle to go live, right? You can always catch this recording on my channel under the live section. So I'm not sure what the reason for that is, Patrick. So let's take a look at the contracts, right? So first, we're going to see all of the expiration dates, right? So here's all the dates. Now I think you guys know this by now, I like weekly income. And I like weekly income for two reasons. I want to capture and lock in income on a regular basis every single week, right? Because I like income every week as opposed to every 2 weeks or every 4 weeks or et cetera. And then also, I don't want to tie up my capital for an extended period of time. I don't know what's going to happen tomorrow or next week or next month. It's interesting, like yesterday I spent some time like looking through YouTube because I wanted to kind of just get an idea of other people that are, let's say, posting content like I'm doing. And I saw tons of things about, algorithms and trading programs and trading signals and day trading and all these different things. And then with the options people that are on YouTube, I saw a lot of content that had to do with, lots of different types of strategies, like strangles and iron condors and butterflies and all these things. And my content is pretty simple. Sell a put, sell a covered call. Somebody commented on my channel earlier today on one of the videos, like, Michelle, I love your content, but you're saying the same things over and over again. Like, hey, this is supposed to be easy, and this is supposed to be kind of boring once you're doing it the right way. So if that's the case, you are not misunderstanding anything. So what I'm going to do is I'm going to look at a 1 week contract. So today's Monday, right? I think it's the 22nd. I'm going to look at the 26th. Now, one important thing to note is we have Christmas this week. So the market is closed on Christmas, and I think it also closes early the day before. You can look that up yourself. You would just go to, I don't know, I think it's NYSE holiday hours right here. And that kind of tells you, yeah, right here, what the holiday schedule is. But because the week is shortened, right, there's not as much time as, let's say, last week, the premium is not going to be as much. So that's something to keep in mind. So right now, Mara is 10:06. I want to put a trade in, and then I want to go to some questions. Now, I noticed a couple things. Now, I don't use a lot of stuff here. This is what I use. I look at what's the bid and the ask. The bid is 55 and the ask is 58. That's pretty narrow, right? Sometimes when you're trading something that's not, let's say, as popular or not as active, you might see a wide bid to ask spread. Like maybe the bid might be 20 cents and the ask is $1 or something like that. The problem with trading tickers like that is you gotta like give up a lot to get in. And if you have to exit early, oftentimes you'll get like not a very good fill. So I don't particularly like things like that. I like things that are actively traded. And in fact, if we look at this contract as an example, I'm looking at, like, for example, the $10 put. The open interest is 6,800. So that's how many contracts are open. It's a lot, right? It's not 5, it's not 10, it's 6,000. Volume is how many are traded today. So 8,900. So that is super healthy. So a healthy open interest, a healthy volume. I'll also look at implied volatility. I like stuff upwards of 50% because the higher the implied volatility, the more I'm going to put in my pocket, right? And then secondarily, I know when it has high implied volatility, it's got swing both ways. So I can feel more confident if the stock goes down, I can more confidently sell another put at a lower price. And if I had to buy those shares, I'm going to be buying them at a lower price and averaging my cost down, right? So that's what's important. That's what I'm looking at. Now, I'm never going to put a trade in unless I calculate the rate of return because I want to make sure it's a good deal. So let me take a look. Let me pull up a calculator here. And let me calculate the rate of return, and I'll show you how easy it is. So I'm just going to take the bid, right? So it's 24 bid, 25 ask. I'm going to divide 24 into how much money do I have to put up to make this trade? Well, if I'm not using margin, it's the strike price times 100 shares, right? $10 for the strike price times 100 shares is $1,000. So I'm taking in 24 bucks. I'm putting up 1,000, and I'm making 2.4% for the week. If I annualize that out, I'm making over 100% on my money. Now I could go a little bit lower, right? On the delta, right? So a little bit lower than where the stock is trading. Let's say a $9.50 put, and that's trading at $7. Now, when I have a small account and I see the premium is kind of small, I want to be conscious of the commission that I'm paying. So everybody's going to be paying a commission, which is how much do you have to pay in a fee to put the trade on. So that's what your broker dealer charges you. So when I'm making $7, I think I pay 61 cents in a commission. So I'm going to do 7 minus 61. Now I don't always walk through these steps to be exact. Sometimes I just kind of take a rough idea. But this is what I would net on this trade, right? So $6.39. And for this trade, if I sold the 950 put, I'm going to divide by $950, and that's about 0.6%. Now, annualized, that's far less. Now, sometimes people will ask, well, how do you decide, Michelle? Like, what makes you decide to do a $950 put or a $10 put? Well, here's how I look at it. First of all, there's no right or wrong. When you're putting trades in, you have to do what you feel is comfortable for you, right? What I look at is how okay am I to buy the shares if I had to buy them. For me, I'm going to sell a $10 put. Now, I know it's pretty much close to the money, but I'm okay buying 100 shares at $10 for a couple of reasons. Number one, I don't have any positions in this account, and this account is $5,000. So if I did have to buy those shares, it's only going to represent about 20% of my overall value, right? So if I have $5,000 and I'm investing $1,000, that's 20%. And you could check the math, but that's kind of an easy number to do. So for me, I'm gonna sell a $10 put, and I'm gonna make $25. So again, 25 into $1,000, it's a 2.5% rate of return. Let me put the trade in now, and I'll show you how to do it. Now it went down to 24. I'm gonna put a limit order, so I'm gonna talk about that in a minute. Selling one Mara 1226 $10 put for $25, and I'm just gonna hit send here and confirm and send. And then we see the fill in the upper left-hand side. Now that was 24 bid and 26 ask. Let me take a moment and explain to you what that means for those of you who may not know. So the bid, if I put an order in at the bid, it will fill right away because that's the number. There's already buyers that are lined up that would pay that price. If I put an order in between the two, I think it was 24 bid, 26 ask, I believe. If I put it in between, it may or may not fill. Sometimes the market makers will change the bid and the ask once that order is up there. So you have to do, it's kind of like a little bit finesse. It's like a little bit of trial and error. And that's kind of how that works. So now I just want to double check that position here. And I'm just going to go to positions. And here's my Mara put. Now, also, I want to make this note. You want to make sure it says -1. So I was working with someone recently, and I was helping him walk through some trades and checking some of his stuff. And he had a trade he didn't realize, and it said 1, and he bought the contract instead of selling the contract. So that's something that you want to double check and make sure you don't make a typo when you enter that order. So here's our trade, right? So the cost per share is $25. That's how much I got paid for selling this contract, right? I don't really care about the day change right here. I'm just gonna like let it cook, you might say, and let it do its thing and see how that goes. Now sometimes, let's say the price starts going up and Thursday, Friday, or whatever, the price is going up and maybe the value of this contract is like $1 or $2 or $3 or something like that. I'm going to look at perhaps buying that contract back, liquidating it, and locking in that gain. And the reason for that is because it takes the risk off the table, right? So the most that I can make in this trade is $25. So oftentimes, I don't want to be greedy. I don't need to make the whole thing. Oftentimes, I will buy it back and give back $1 or $2 or something, lock in that gain, and then sell another contract. In fact, I think what I'm going to do is go live every single day that the market is open. I was thinking this yesterday. I was like, man, I spend a lot of time making videos, editing them, this and that. I'm going to try this new format, and I'm just going to go live every day that the market's open at, I think at 3 o'clock. The time might change, but if you're subscribed, you'll get a notification as to the time. And then also just, I always put in the comments or in the description the time zone. So I know last week or a couple weeks ago, I think it said the time zone was off. So oftentimes I'm between LA and New York. and sometimes the time zone gets changed in my program. So just make sure that that you make note of that. But again, if you miss the session, it's recorded. So let me go through some questions here. Give me a moment while I take a look. Boston One Kid. First of all, I think that's Boston One. First of all, I appreciate you. I know that you put a lot of comments on my YouTube and you're watching a lot of my videos, and I sincerely thank you, and I'm super glad that you're interactive with the content. So Boston One asks, what is a good percentage after you annualize a stock? That's a really good question. So after you annualize that rate of return, I think over 50% is always really good, because if you're making 50% on your money, it's like, that's like my benchmark typically. I do enjoy over 100%, but again, sometimes you have to sell something a little bit closer to the money. But typically, I won't do a trade if it's under 50%. That's a really good question. Okay, one question. Daryl is asking, let's see. Do calls trigger sale at the break-even price? Robinhood shows two prices, if that makes sense. Okay, so that's a great question. I don't really look at break even. I know if you go through like the platform, you can do a lot of like this kind of stuff and look at what your break even is. I don't do that. I think that people can make things much more difficult than it needs to be. I think that's the case not just in trading, but in life in general. I was listening to some podcasts on my way here when I was driving, because it was like 40 hours. And some of the podcasts I was listening to were really, really good. I think that we're ingrained, nurtured with certain thoughts and beliefs, right? And some of those are kind of like work harder, it takes hard work to like accomplish something, but things along those lines. But the fact is, I think trading, I think life, I think relationships, I think all things in life in general are supposed to be easy. Now, a lot of people think like, Michelle, that's not true. And I don't believe in that. That's my belief. And I think it can be as hard as you make it or as easy as you make it. I don't look at break evens. Here's what I do look at. Like, for example, I just sold this put here, this Mara put. So I am saying, okay, I'm going to buy 100 shares of Mara at $10 if the price drops below $10. And I'm not going to roll anything. I'm not going to buy anything back at a loss. I might buy the contract back and lock in my gain, but I'm not buying it back at a loss and rolling that contract. And I'm prepared to take assignment on 100 shares. And the reason I'm prepared to take assignment on 100 shares is a couple reasons. Number one, I like Mara. I like Bitcoin. I like Mara as a company. I think $10 is a great price. And if I have to buy those 100 shares, I'm going to turn right around on Monday and sell a covered call against it. And if the price continues to go down, I'm going to consider selling another put as the price goes down. So I don't look at break even. And I'm also not familiar with Robinhood. I never traded Robinhood as a stock, and I never used them as a broker. But I do know that a lot of broker dealers will use break even metrics and data, and I just don't use that. I think it's just adding more stuff. Listen, I can only fit so much stuff in my head. I mean, I don't know. I just want to focus on the important things, and that's how I look at it. Okay, let's take a look at the next question. What is the purpose of the strike prices that are on top of the strike prices when trading a put? I'm not sure exactly what that means. Let's see. What are the purposes of the strike prices? I don't know what that question means, so you can clarify and I can come back to that. Let's see. Deacon, give her a like. I appreciate that too. Listen, I have some really, really good viewers in my channel, and man, that makes me feel good. Sometimes people like write things like this, give her a like, send some emojis, that kind of thing. Emails and comments on my YouTube. I appreciate that. Thank you. Why doesn't Schwab Thinkorswim show the adjusted cost basis after the assignment? Oh my gosh, William, this is a really good question. Man, do you guys see the value? Send some hearts in the platform now if you guys see the value, because I think you guys are asking really good questions, and these are questions that I don't necessarily think of when I do a video. So I think that's good. I appreciate that. So William asked this: Schwab and Thinkorswim, why don't they show the adjusted cost basis after the assignment of a put sold? I'm going to explain that to you, and I'm glad that you asked. So here's what Thinkorswim will do. Let's say I get let's say Friday happens and Mara ends at $9.50 and I get assigned those shares. On Monday, I'm going to show 100 shares with the basis of $10 because that was the strike price. On Tuesday, I will show the adjusted cost basis. So for example, I sold this for 25 bucks. Let me pull up my calculator. So 10 minus 0.25, I could do that in my head, but I'll just show you, on the screen. If and when I get assigned, if I was to get assigned on this, on Monday, my cost basis will show $10, and on Tuesday, my cost basis will show $9.75. I don't know how other broker-dealers do it, but that's how Schwab does it. Also, this is super important to keep in mind. If and when you have multiple lots, like let's say I do this, I sold this put, and let's say I also end up buying 100 shares down the road, at some other price. I'm going to show the different lots in my cost basis, and then if and when I get a covered call assigned, you have to call Schwab and tag those shares to the correct lot. So that's important, and you only have Monday to do it. You have like the whole day of Monday, and then if Monday passes, you can't change that. So let me know in the comments if you guys need any clarification. That's a little bit in addition to what William asked. But when you have multiple lots, like 200 shares, and I bought 100 at $9, and I bought 100 at $9.62, and then I sell, let's say, a $9 call and then a $10 call. If and when those calls get assigned, you have to call the broker-dealer and tag those to those lots. Because if you don't do that, it will go based on whatever your default is, and that might create a loss. It might create a wash sale. I don't want to go into too many weeds and details, but you don't want that to happen. So you want to make sure that you do that. We're going to do that as we go because I'm sure I'm going to end up having 100 shares of this and maybe 100 shares of, at a different price. Okay, let's, thank you for asking that question, William. Let's see. Okay, I just made the trade exactly like yours, but do I see it filled or am I not seeing it? So you can see fills. Some people look at the monitor tab on Thinkorswim. So you'll see if I had a working order, it'd be here, right? Working orders, or you'd see filled orders, but I don't look there. I look here, right? So I look right here on the positions tab. So that's where you would see it. If you're paper trading, you might not see it. Paper trading, listen guys, paper trading is kind of a pain in the neck. I don't think it has a lot of value. I'm going to be honest. I know oftentimes I have, thoughts and beliefs that are contrary to mainstream thoughts and beliefs. Lots of people will tell you to paper trade. Number one, if you're paper trading, you might see, you might put a trade in at the bid and then you won't see the fill because it only works based on other live trades. So that's like a deficiency. So that's like a flaw in how it works. And then also probably more important than that, when you don't have money, real money on the line, it's like playing with Monopoly money. I don't think it really teaches you anything. I think it's better to just start small. Start small, start slow. Make sure you have, you understand the concepts before you trade, but I'm not sure if that's the reason why. I have a lot of questions here. Let's see. What happens if Mara goes to $5 if Bitcoin continues to go down? Will you sell another put, or would you take assignment and sell a call on the shares that are now down? Yeah, that's a good question. So number one, I'm going to take assignment because I'm already prepared to buy 100 shares at 10 bucks. That's mentally where I'm at when I put the trade on. And if it does go down to $5, absolutely, I'm going to sell another put. Now, if it goes, when things go super, super cheap, I encourage you to really pay attention because what you want to be conscious of, right, is a reverse split. So when things go down super, super cheap, you don't want a reverse split to happen. So that's something that I would be conscious of. But for Mara, if the price is going down to $5, yeah, I'm going to sell another put. I'll probably sell 2 more puts because then I'm really averaging my cost down. Good question. Let's see. Break even, yeah. And I appreciate you when you guys answer each other's questions. Hey Queen, you guys like the name of my new channel? What do you think? What is it? Options. Oh, I forget what's the name of the channel. Options Queen, something like that. Where is it? Cash Flow Options Queen. There it is. Do you guys like the name of that? Let me know. Some of that is like, oh my gosh, I wonder if that's cringy or not cringy. Let me know your honest thoughts. But here's the question. Lots of hearts. I appreciate that. The question is this: sold a put for LW stock. What would you do? Would you do it looking at the drop it had? Would like to pick your brain. Thanks for all the good info. I don't know. Let's take a look. I don't even know what LW is, but let me just add it here. So the way you add a ticker is you just add it to the watch list. LW, and here it is. Let me just sort it by here. I always look at the chart first. Oh my gosh, it dropped a lot. So what is LW? Let me just, usually what I do is LW stock. I don't know. Let me just ask Google. Lamb Weston Holdings, American Food Processing Company, one of the world's largest producers of and processors of frozen French fries, waffle fries, etc. Okay, so here's how I think about things in general when stock drops like this. If I already have a position in a stock, like my most important thing is like, what's the ticker that I want to trade? That's like the most important thing rather than the price. Like, do I believe in this ticker? Do I think I can make some money and a good rate of return trading puts and calls? Would I be comfortable holding 100 shares or a couple hundred shares or whatever that number might be, you know, for an extended period of time if I had to? So that's my first important thing. The second thing that I think it's important to note is if it goes down and it's the same company that it was before, for me, those are opportunities to buy more shares, as long as you're not like overextended. So I think part of the secret in options trading is really like being very careful in your position sizing, right? One of the biggest things that I see, especially new traders do, is they go kind of like cowboy mode, I call it. Like they trade way too many tickers and way too many positions, and they don't really think about like how much am I committing versus how much capital is in my account. I've done that myself. Listen, I've gotten in lots of trouble in the past with margin, so it's kind of similar, right? So when you're using margin and you don't have enough money like to maintain those positions if they drop, that's the only thing that's going to get you in trouble. But if I was trading, I've never traded LW and I never heard of it until now, but if I was trading that and I like that stock and it dropped down, now that gives me an opportunity to buy more shares, sell another put. Like in fact, let's see. So right now it's $42. Let's take a look. So actually, if I look at the options chain, personally, I wouldn't be trading this because it doesn't even have weekly options. It just has monthly. So you can see January, February, April, etc. So let's take a look at the January options chain, right? Yeah, so $40, 30, 35. I mean, the implied volatility is decent, 30%. You know, open interest is pretty high. This is probably high because of the big drop. One thing that I notice when I look at this is what we call a gap in the chart, right? So this low 3 days ago was $58, and now this high yesterday, or Friday rather, was $50. So it dropped all the way from 58 to 50 overnight. So gaps typically fill. That's important to note. So if this is a good quality stock, it will likely at some point fill this gap. Like see this gap right here where it gapped up and then it came down to fill that gap. Over here is another gap right here. So it gapped up and then it came down. So gaps both up and down will typically fill. So if I like this stock, I would feel comfortable perhaps selling another put and averaging my price down, you know. And here's how you want to do that. Like, let's say, let's say I have a video with an Excel spreadsheet that automatically calculates it, but I'm going to show you how to do it on a calculator. Let's say I have 100 shares at $61, right? And then let's say I sold a $40 put, just as an example. What I do ahead of time is I calculate, okay, if I sell a $40 put and if I were to get assigned on that contract, what would my new basis be? So this is how you would calculate it. You might already know this, but for those of you who don't, I want to walk through it. $61 plus, let's say if you bought another 100 shares at 40 bucks, and you have 200 shares now. Now your new basis is 200 shares at an average basis of $50. So there's really, like, when you're trading something and then it drops like a rock, you can wait, and you might be waiting all day, like twiddling your thumbs, right? Or the best way to really exit that position, like turn that losing position into a winning position, is to buy more shares when it goes down. Sometimes oftentimes actually, it feels uncomfortable to do that. And really, that's why you want to start with a good quality stock that you believe in initially. Because if you're trading a good stock and it goes down, hey, the stock's on sale. There's no reason why you wouldn't want to do that. But you have to kind of like rewire your brain to understand those things. Good question. Let's see. Can you explain the lot sizes again? Yeah, so that's a good question. Premium Wheeler. Oh, I like the name. This is important. Actually, a couple weeks ago, I had a bunch of Applied Digital shares, and I bought them at all different prices. Like I had 100 at this price, 100 at that price, 100 at that price, and then I was selling covered calls against, let me pull up Applied Digital and I'll kind of like walk you through it. This is actually a really good question. So for example, Applied Digital is $28 and change, right? $28.04. Now let's say if I bought 100 shares at, $30, and then I bought 100 shares at $29 and 100 shares at $31. You can do one of a couple things when it comes down to selling covered calls against those shares. You can sell multiple contracts. Let's say let me give you an example. Let's see, how do I do that? Let me pull up a calculator. Let's say, I'm just going to use easy math. Let's say I buy 100 shares at 31, and then 100 shares at 30, and then 100 shares at 29, right? You could do that. You'd have 300 shares, right? And with an average price of $30. So 31 plus 30 plus 29 divided by 3. So you'd have 300 shares at an average price of $30. So when you have multiple lots, you can sell multiple contracts at your average basis. I'm going to walk through that first. This is actually a really good question. Let's say if I sold 3 contracts with a strike price of $30 and then they got assigned, I'm actually going to have a loss on one of them because I bought 100 shares at $31. So if you were to do that, sell multiple contracts at your average basis, you should not buy that stock again for 30 days because you're going to have a wash sale. It doesn't really matter. It's not really important what's a wash sale mean. You don't want to do it because it's confusing and you just don't want to do it. So if you sell multiple contracts at your average basis and then they get assigned, don't trade that ticker for 30 more days. Or you can sell 3 separate covered calls and then tag them to each of your lots. So in other words, if I bought 100 shares at $29, I could sell a $29 call. If I bought 100 shares at $30, I could sell a $30 call. And if I bought 100 shares at 31, I can sell a $31 call. What happens is, let's say the stock closes on Friday at $29.80, and only your $29 contract gets assigned, but the other 2 expire worthless. You need to call Schwab to say, hey, that contract that got assigned on Friday, that $29 call, I want the shares from X date, let's say December, whatever your purchase date is from those shares, and whatever the cost basis is from those shares. So you have to call them the same day and tell them, and then they'll match that. Otherwise, they're going to use whatever default you have in your account. It might be like first in, first out, or last in. Best practice is just to call them. And you only have Monday to do that. You have Monday, I think, all day. So that's important. Otherwise, it might create a loss when you didn't want to create a loss. So hopefully that answers your question. Let me see what other questions. I have tons of questions. Let's see. Make sure to sell the call at or above the strike price you picked, not the adjusted cost basis, or you'll be selling the shares at a loss, but the premium you received. So that's a good point. Let me just walk through that. Because we're talking about, okay, if I sell a put and then the shares get assigned and then I sell a covered call, you could sell a covered call at your adjusted basis if you want to. It's not going to create a wash sale in your account. It's not going to create anything. Most people will sell a covered call at whatever their strike price was because it's just easier to pay attention. Okay, if I bought the shares, like let's just use me as an example. Where was my page here? If I bought the shares at $10, I'm going to sell a $10 call. Usually that's what I do. Good point. Let's see. Love the name. Awesome name. Name is good. Thank you, by the way. Not cringy. Appreciate that. Michelle, would you ever sell a call you were assigned lower than the original strike price to get premium if the gap to current price was substantial? I have done that in the past. So that's a really good question. So let's say if I bought the shares at $10 and that stock dropped all the way. See, the problem when a stock drops a lot is that the call premium is not worth that much, right? Because the price is going down so much. It's risky to do that because if you sell a covered call at with a lower strike price than what you own the shares for, I mean, if you get assigned, you're going to have a realized loss. And I try not to. I really do everything in my power to try not to create a realized loss. I prefer in that case is selling another put as the price comes down, taking in income. If I have to buy those shares, I'm going to sell a call tagged to that particular lot. I have done that in the past just because, I'm sitting around waiting and I want to just take in some income, but it's not a really good idea to do that. Ultimately, it's your decision. That's a really good question. Okay, so I have, here's a good question. I have 200 shares of coin with let's pull up coin here. Let's see, coin. COIN, Coinbase. So first we're going to look at the chart, right? So I have 200 shares of coin with a cost basis of 300. I don't want to buy more shares or sell more puts because I don't want to use all my capital on one stock. Yeah, that's a good point. That's why it's really important to make sure you size your stuff correctly. Like for example, let's say I don't know how big your account is, and I'm not going to ask you here or anything, but let's say you saying that you don't want to use more capital. For me, what I would have done, let's say instead of trading coin, maybe trade a different Bitcoin that's not as expensive of a ticker. Because really the best way to make a trade that's not really doing well to do well again is to buy more after it comes down. But that is a fair point. It's hard to do that, and in our brains it doesn't feel comfortable, right? So it's kind of like, oh my gosh, this stock is going down, and it's not really a good stock anymore. It's still the same stock as it was before. All stocks go up and down. That's the best time to do is to force yourself and sell another put if it goes down. Like for example, if I had coin. I would, if I had 200 coin at $300, I mean, it's not that far away right now. I would sell, maybe another, I don't know, $200 put. If and when I get assigned, it would average your cost down. But good point. What's your opinion on pairs trades? I don't even know what that is. I think I've heard of that before. If you put what it is in the comments, I'll look at it again, but I'm not sure. let's see. When I looked at the 300, this is relative to the coin again. When I looked at the $300 strike price for this week or next week, the premium was not that good. Should I go out a month or wait for the stock to recover? Let's take a look at the premium. So if you're right, if the stock is trading at 248 and you're looking at a $300 call, yeah, there's no premium. I don't like going out a month because you're tying up capital. Coin and lots of stock has a lot of volatility. I mean, the implied volatility, for example, for coin is 60%, something like that. It could pop pretty significantly, and then you're stuck in there for a month's time. Me, I would always, if you have 200 at $300, hopefully you have 100 at one price and 100 at a different price, probably lower, I'm guessing. Me personally, I would perhaps sell a call on that one lot with that lower basis, because then you might get a little bit more premium. Maybe go out 2 weeks. Right now is kind of a hard time because, again, like Christmas is this week. Next week you're going to have New Year's. So the premium is not as much as it is relative to a full week. Let's see. I wish I could sell the call at 260 and the 260 lots get called away. If you have 100 shares at 260, why don't you do that? I mean, that premium is decent. For this Friday, it's 125 bid. I mean, I'm assuming if you have 200 shares at $300 average and you have 100 at 260, you probably have 100 260 and 100 at like 340 or something like that. Then yeah, sell a covered call at 260 and you make 125 bucks. Listen, there's nothing wrong with making money. Like, we have to like really teach ourselves, like, don't be greedy. Make sure you pay attention to the realized gains versus the unrealized gains. That's probably the most important thing. But there's nothing wrong with making cash. Let's see. Who else has some questions? Is this helpful? Walking through this, like real trades, putting a trade on, showing you in the platform exactly what buttons to click. You want to use limit orders when you trade an options contract. You don't want to use a market order. That's how I do it anyway. That's like best practices. And you want to make sure you check what you did here on the positions page. I really hope that this info is helpful. Let's see. I think I don't have any other questions. I wanted to go about 45 minutes, which we're right on the 45 minutes. Yeah, so I want to say thank you all for attending. I'm going to, I think what I'm going to do is every day the market's open, do a quick live, at least jump in for a few minutes and kind of look through, okay, where's the position right now? Is it up? Is it down? How do we read what we're looking at? I think that would be helpful. As far as the time goes, I think what I'm going to do is stick with 3 o'clock. But the best thing for you guys to do is just take a look and make sure you see it. And if you're subscribed, you should, and if you have notifications on, you should get a notification. So I will probably see you tomorrow at 3 o'clock then. Anyway, thank you for watching. Let me know if you guys have other questions as we go. And then I think there were a couple of other questions that came in after I said we were splitting. So just ask those tomorrow. Thanks again for watching, and have a great day.